Welcome to Rec TV Education. Today we are going to see one of the topic in accounts, that is amalgamation. Before understanding what is amalgamation, let us say a simple example. Here there is two companies, X company and Y company. These both will join together and they form a new company, that is here Z. That is nothing but amalgamation. That is, two or more companies are joined to form a new company. For amalgamation, at least there must be three companies, that is in this case X company, Y company and Z company. And under amalgamation, two existing companies will amalgamate and they form a new resultant company. That is, there may be n number of existing companies, but the resultant company will be only one. So this amalgamation is done to cut the competition in the market. Next, let us see what is absorption. Absorption is a part of amalgamation. Amalgamation also deals the accounting treatment for absorption. Here absorption means one company will absorb the entire business of another company. Here in this example, let us take X company and Y company. Now X company is an existing company. It will take the entire business of another existing company, that is in this example we are taking as Y company. Now based on this example, let us see a few points based on the absorption. Now the first point in absorption is an existing company takes over the business of one or more existing companies. That is, here X is an existing company and also Y is also an existing company. That one company is taking the complete business of the another existing company. Under absorption, at least two companies are involved. There may be more than two also, but at least two companies are must for the absorption. That is in this case X company and Y company. No new resultant company is formed. Here in this example, both are the existing company. One existing company is taking the entire business of another existing company. This is the main difference between amalgamation and absorption. In amalgamation, already the existing companies will join and they will form the new company. But under absorption, one existing company will absorb the another existing company and no new resultant company is formed. But the same point in two, that is in amalgamation and absorption, these both are done to cut the competition in the market. Before forwarding this topic, let us understand two simple terms, what is a transferor company and what is a transferee company. The Companies Act does not define the term amalgamation clearly, so the ICA has introduced Accounting Standard 14 on accounting of amalgamation. So according to that Accounting Standard 14, amalgamation is of two types. One is amalgamation in the nature of purchase and another one is amalgamation in the nature of merger. For the amalgamation to be a merger, it has to satisfy 5 conditions simultaneously. If any of the condition in this 5 is not satisfied, then amalgamation is said to be amalgamation in the nature of purchase. Now let us see what are the 5 conditions to become amalgamation in the nature of merger. The first condition under amalgamation in the nature of merger is all the assets and liabilities of the transferor company is to be transferred to transferee company. In the previous example, we have already seen that X and Y is an existing company and Z is a newly formed resultant company. So that XY company is a transferor company, that is which is transferring the business, and the Z company is a newly formed resultant company which is nothing but a transferee company. Another name for transferor company, we can say that it is a vendor company, and another name for transferee company is a purchasing company. Now in order the amalgamation to be a merger, whatever the assets the transferor company is having, everything has to be transferred to the transferee company. After satisfying this condition, if we look forward to the another condition under amalgamation in the nature of merger, it is that equity shareholders holding not less than 90% of equity holding in the transferor company must become shareholders to transferee company. That is, after amalgamation, the X and Y company, their existence will be lost and new company will be formed. So the owners of that existing company has to become the owners of the newly formed resultant company. If they are less than 90%, the condition is not satisfied and the amalgamation becomes purchase company. Next, another condition under amalgamation to be a merger is consideration which is paid to the owners of the existing company must be only in the form of the equity shares. But if there are any fraction of shares, that must be paid in form of cash also. If the consideration is paid other than this equity shares like preference shares, debentures, in any of the form, if the consideration is paid to the owners of that vendor company, then it becomes amalgamation in the nature of purchase, because it does not satisfy one of the condition to become amalgamation as a merger. So to become this amalgamation as a merger, compulsory the consideration that has to be paid by the transferee company to the transferor company should be in the form of equity shares only. Next, a fourth condition under amalgamation to become a merger is all the assets and liabilities whatever the transferee company is taking from the transferor company, it must be recorded at book values in the financial statements of the transferee company. If they are recorded at the adjusted values or if they are recorded at some agreed values, again it becomes amalgamation in the nature of purchase, because in the condition it is saying that it must be recorded only at the book values. And the last and least condition to become amalgamation as a merger is there should not be made any adjustments in the books of accounts. So these are the 5 conditions which makes amalgamation as a merger. We can say now amalgamation to become how it becomes a purchase. Now let us see the first point. We have already discussed that all the assets and liabilities of transferee company is to be transferred to the transferee company. If some assets remains with transferor company and some assets are given to the transferee company, so this condition it won't satisfy and again the amalgamation becomes purchase. In this way one of the condition is not satisfied, so it is not a merger. And a second point, if we look very clearly, the equity shareholders holding not less than 90%, that is if they become 89%, so also it is not a merger. And remaining points we have already discussed. Now let us see what is purchase consideration. Normally if we buy any goods from another company, generally we pay consideration for that. Like that also under amalgamation, one company is purchasing the business of another company. So for taking that business, this company whichever is taking the business of another company has to pay something to the owners of that existing company. Now that is nothing but a purchase consideration, that is any price, that is whatever that may be in the form of cash or that may be in the form of equity shares or preference shares or debentures or that may be in the form of any asset, whatever it is which is paid by the vendor company, that is a selling company, to the owners or the shareholders of the purchasing company, that is nothing but a purchase consideration. Now this purchase consideration may be of in 2 methods. One is net asset method, that is to calculate the purchase consideration according to the problem given, we can make it as a 2 types. One is net asset method and net payment method. Net asset method is nothing but aggregate of assets taken over by the purchasing company and the liabilities whichever is settled by the purchasing company, the remaining whatever is there, that is nothing but a purchase consideration which is to be given by the purchasing company to the shareholders of the vendor company. Now let us see another method to calculate the purchase consideration, that is net payment method. If the purchasing company makes an agreement with the vendor company that it will pay something like in the form of equity shares, I will pay something in the form of debentures, I will pay something in the form of preference shares or in the form of cash, that if it explains the mode of payment, if it agrees the mode of payment with the vendor company, that is nothing but the net payment method. That is whatever the purchasing company pays to the vendor company, that is nothing but a purchase consideration which is the consideration payable by the purchasing company to the owners of the vendor company, that is an existing company. We have already seen what is meant by purchase consideration. It is nothing but any price paid by the purchasing company to the owners of the selling company. Now to understand how to calculate the purchase consideration, let us solve a simple problem in this class. I have already told you that there are 2 methods to calculate the purchase consideration. Now to decide which method we have to select, we have to first understand what is the content given in the problem. based on the content, based on the question given in the problem, we have to decide whether the purchase consideration is to calculated based on the net asset method or the net payment method. Now let us look into the question very clearly. Now in this problem it is given that balance sheet of X Limited as on 31st March 2011. So under liability side they are having equity shareholders 75 lakhs, I have written it in thousands form, and 14% preference shares of 100 each, 25 lakhs, that is in thousands it is given 2500. Now this balance sheet also having a general reserves 1250, 12% debentures 4000, and current liabilities 20, that is 20 lakhs. Now when we look at the asset side of this balance sheet, they are having a land, that is 50 lakhs, plant and machinery 45 lakhs, furniture 10 lakhs 50,000, investment 5 lakhs, inventory they are holding 23 lakhs, trade receivable, that is debtors 24 lakhs, and this company is having a cash and bank balances 15 lakhs. Now here under this problem again they have given the additional information. This is very important to solve any problem. This additional information is very important. So by reading a one point we have to construct the what is the problem given in this in our minds. Now let us say a first point under the other information. Here Y Limited takes over X Limited on 10th April 2011. In the problem and in other information it is saying that Y Limited is taking the business of X Limited. So here Y Limited is a purchasing company and X Limited is a selling company, and debenture holders of X Limited are discharged by Y Limited at 10% premium by issuing 15% own debentures of Y Limited. If you look at the balance sheet of X Limited, the debenture holders are holding a 40 lakhs amount at 12% rate. Now they are discharging by issuing 12% own debentures of Y Limited. Now let us first imagine whether to take this debenture holders in the calculation of purchase consideration or not. We have already seen the purchase consideration is nothing but the any amount paid by the purchasing company only to the shareholders of the selling company. These debentures are not the owners of the selling company, they are only the creditors of the selling company. So if the purchasing company is discharging the any creditors of the selling company, it is only the liability they are discharging, not the purchase consideration they are giving to the owners, because they are only the creditors, not the owners of the selling company. Now another point if we see under the other information, it is 14% preference shareholders of X Limited are discharged at a premium of 20% by issuing 15% preference shares of Y Limited. Now if you look at a balance sheet of X Limited, there are 14% preference shares of 100 each, that is 25 lakhs, 2 lakh 50,000 preference shares are holding by the preference shareholders. Now these are the owners of the X Limited company. So whatever the amount, whatever the price the purchasing company is paying to the selling company, that is nothing but purchase consideration. Now this third point considers a very important in calculation of purchase consideration. So here they are discharging that at a premium of 20%. So now if it is 100%, they are discharging at 120%, and the interest rate whatever is there, that also they are increasing to 15%. Now another last important point to calculate the purchase consideration is intrinsic value of X Limited, that is market value of X Limited is 20. Now the present market value of X Limited, if they sold the shares in the market, that is 20, and Y Limited is 30. Now this Y Limited will issue equity shares to satisfy the equity shareholders of X Limited on the basis of intrinsic value, and they will issue this equity shares at value of rupees 10, and this is also the nominal value of equity share is rupees 10. Now by collecting all this balance sheet of X Limited and by collecting all this other information, now let us compute the purchase consideration. So after looking this question very clearly, now we can frame which method is to consider to compute the purchase consideration. Now we can say very clearly that the purchase consideration is to be calculated on the basis of net payment method. Why I am saying net payment method is, Here X and Y, that is Transferor Company and Transferee Company, both are agreed, and the purchasing company is agreed to discharge the owners by paying sum. Here that is mode of payment is given in the problem. I already told you that if nothing is mentioned about the mode of payment, we have to follow the net asset method. If there is any mode of payment is mentioned in the problem, then we have to follow net payment method. So on the basis of this, let's start the solution how to compute the purchase consideration. Now purchase consideration is nothing but whatever it is given to the shareholders of the Transferor Company. Here in other information we have already seen the third point, that is preference shareholders, and fourth point is equity shareholders. Now that is the purchase consideration. Now let us see how to calculate this. So here in the problem they have given that they will discharge the preference shareholders at 20% premium by issuing the 15% preference shares of Y Limited. For preference shareholders of X Limited, 30,000 of 15% preference shares of Y Limited are giving to the preference shareholders of X Limited to discharge their 14% preference shares holding in the X Limited. Now the main important point in this computation of purchase consideration we have to see is what they are doing to discharge the equity shareholders. So that is, in the problem it is given that equity shareholders are discharging on the basis of the intrinsic value. Now the intrinsic value of X Limited is 20 and Y Limited is 30, but this Y Limited will issue to the X Limited at the rate of 10 per each share. Now after calculating all this, we will get 5 lakh equity shares of Y Limited. So that is total purchase consideration after taking the preference shareholders and equity shareholders we will getting is 8,000, that is 80 lakhs. Already we have seen, as per accounting standard 14, amalgamation is of two types, that is one is amalgamation in the nature of purchase and amalgamation in the nature of merger, and we have also seen how to calculate the purchase consideration. Now let us see, for the accounting purpose, under purchase and under merger, what are the methods to be used to be entered in the books of accounts in both the purchasing company and the selling company. If the amalgamation is in the nature of purchase, we have to accountify under the method purchase method. If the amalgamation is in the nature of merger, we have to accountify it under the pooling of interest method. Now let us discuss very briefly what is purchase method and what is pooling of interest method. First let us see purchase method. Under purchase method, there are 3 steps what we have to do while recording the entries in the books of the Transferee Company. First, the assets and liabilities of the Transferor Company, that is nothing but the selling company, must be recorded at carrying amounts in the books of Transferee Company, that at whatever value the purchasing company is taking the assets and liabilities from the selling company, exactly the same adjustments has to be made in the books of the purchasing company. Second one is the reserves and surplus in the balance sheet of the selling company should not be incorporated in the financial statements of the Transferee Company, that is the purchasing company, but only the statutory reserves, that is the compulsory reserves which has to be maintained compulsorily, are to be incorporated in the financial statements of the Transferee Company. And the reserves and surplus, whatever is there in the remaining in the financial statements of the vendor company, it is to be transferred to the equity shareholders of that company. Now whatever the assets we are taking and whatever the purchase consideration we are paying to the owners of that selling company, if we consider that difference, there will be any difference, that is if we incur any loss. As usual, if we purchase anything, if we incur loss, and sometimes we may incur gain also. If we incur any loss, we will treat it as a goodwill, and if we incur any profit of this business transaction, we will get it has to be reserved in capital reserve. Now let us see, that is if the net assets taken over, whatever we are taking, if it is less than whatever we are paying, that is now we are taking assets from that selling company and we are paying purchase consideration to the selling company. Now whatever we are taking assets is less than the value whatever we are paying, that is we are incurring the loss, that is taking is less than what we are paying, so it is to be treated as goodwill. Now another condition when we will treat is a capital reserve, that whatever we are taking from the selling company is greater than whatever we are paying to the owners of the selling company. So that is we are incurring here gain, that is we are taking more from the selling company and we are paying less to the selling company. So that is to be treated as capital reserve. To accountify the amalgamation in the nature of merger, we are following pooling of interest method. Under merger, we have already seen the 5 conditions. One of the condition in that 5 conditions is all the assets and liabilities whatever there in the balance sheet of the selling company is to be transferred to the purchasing company. The same point is there under pooling of interest method. So all the assets, liabilities, reserves, whatever is there in the selling company, it is to be incorporated in the purchasing company at the book values. No adjustments has to be made in the books of the transferee company, that is the purchasing company. Now if there is any difference between the share capital and purchase consideration, it is to be adjusted in the reserves. The difference between these two methods, purchase method and pooling of interest method, is one is under the purchase method we are not considering any reserves and surplus in the financial statements of the transferee company, but only we are taking the statutory reserves which are to be compulsory maintained as per statute, that only we are incorporating in the financial statements of the transferee company. That is one of the difference between purchase method and pooling of interest method. But under the pooling of interest method, there is no separate that this reserves had to be considered and this reserves has to be considered. All the reserves whatever is there in the selling company has to be taken by the purchasing company. That is one difference. And another difference between purchase method and pooling of interest method is, if here any difference comes between purchase consideration and net assets taken over, it is to be treated as either as a goodwill or a capital reserve. But under the pooling of interest method, if any difference comes between share capital and purchase consideration paid by the transferee company to the transferor company, it is to be adjusted in reserves. That is, no name has to be given specifically, that is goodwill and capital reserve. These are the two important differences what we find between the purchase method and pooling of interest method. After amalgamation, these are the entries which are to be recorded in the books of the purchasing company. In the normal course of business, if the organization purchases, it will record the entry in its book of accounts as purchases to. If it is taken a purchases on credit basis, it will write as purchases to creditors. In the same way, this is a business transaction. Now we are just adding the business in front of the purchase account. So for debit, we are debiting the business purchase account and we are crediting liquidator of X Limited. Once the company is wound up, a liquidator is appointed to receive everything and to pay to the creditors, and whatever the liabilities the existing company is having, the liquidator will see after all those. So I am giving the credit to the liquidator of X Limited. So the amount which the X Limited, here X Limited is nothing but purchasing company. So whatever he agreed to pay to the owners of the selling company, that amount I have to add to this account, that is business purchase to liquidator of X Limited. Now the second entry is, this purchasing company will take some assets and will settle liabilities of the selling company. Now when it is taking assets of the selling company, it will debit the assets, and if we settle the liabilities, it will credit the liabilities. So here I have taken 3 assets as example. One is land and building, plant and machinery and patents, and liabilities I have taken only trade payables. This business purchase is also liability to the purchasing company, so it is also recorded in the credit side, that is a business purchase. If there is any differences, that is if the credit, after recording all the balances, if the balance is more in the debit side, we have to give credit side as a capital reserve. That if the credit side balance is more than the debit side, so goodwill is to be recorded at the debit side. Another entry, so first entry we have seen a purchase consideration new, next entry we have seen the assets taken over and the liabilities settled. Now the next entry will be, this purchasing company will settle the amount payable to the selling company. So that is to whom it will pay, the liquidator of X Limited. So that is liquidator of X Limited to whatever form it will pay, that we have to give as a credit. Now in this example I have taken, it is paying to the liquidator of X Limited some cash and some in the form of equity shares and some in the form of preference shares. So the entry is liquidator of X Limited to cash, to equity share capital, to 14% preference share capital. So this is being payment is made to discharge the purchase consideration due by the purchasing company to the selling company. If there are any liquidation expenses are paid, so the debit will be given to the goodwill account and credit will be given to the cash account. So the entry is finally goodwill account to cash account, that is being liquidation expenses are paid by the purchasing company. If the liquidation expenses are met by the selling company, then no entry will be recorded in the books of the purchasing company. If we see second entry and fourth entry, if under second entry, after taking all the assets and after settling all the liabilities, if we get any capital reserve and if there is any goodwill account also, then the goodwill is to be set off from the capital reserve. That is, in the financial statement of the purchasing company, there should not be both the accounts, that is goodwill and capital reserve. If there is any capital reserve, then whatever the goodwill is having, that is to be set off from the capital reserve. Now after amalgamation, now let us see what are the entries to close the books of the selling company. Because their business comes to an end, now we have to close their books of accounts also. Now these are the entries that has to be recorded in the books of the selling company to close the books of accounts. First we have to open a realization account and transfer all the assets and liabilities of the balance sheet to the realization account. That is, the entry is, first the assets will be having debit balance. Now when we transfer it to the realization account, it will be entered in a credit, that is realization to all the assets. In the same way liabilities also, that is liabilities to realization account. After opening realization account and after transferring all the assets and liabilities to the realization account, if any cash is realized from this assets and if any liabilities are settled, everything has to be affected in realization account only. Realization account is nothing but a normal profit and loss account. Now the second entry to close the books of a selling company is, now for the selling company, it is selling their business to another company. So it is a sales. So if the sales are on credit basis, we will be having debtor. Here for the selling company, the debtor is Transferee Company. So the entry is Transferee Company account debit to realization account. Now the purchase consideration is received by the selling company from the purchasing company. Now the entry is that purchasing company is giving equity shares and cash to discharge the purchase consideration. So the entry, equity shares of the Transferee Company, that is purchase company account, cash account to Transferee Company account. Now this fourth entry is very important. Now in the balance sheet, after opening the realization account, all the assets and liabilities are transferred to the realization account and there will be share capital, reserves and surplus, any profit or loss remains in the balance sheet. Now we have to close total balance sheet. So this share capital, reserves and surplus, whatever there in the balance sheet are to be transferred to the equity shareholders, because ultimately they are the owners of the company. And if there is any profit or loss in the balance sheet remains, it is also to be borne by the equity shareholders. If there is profit, they will enjoy that benefit, and if there is any loss, they have to borne that loss also. And after tallying realization account, we will get either profit or loss. That any profit or loss in realization account is also be transferred to the equity shareholders account. Now after receiving purchase consideration from the purchasing company, this liquidator of the selling company has to distribute this purchase consideration to the owners, that is to the equity shareholders. So that is why I have written here, purchase consideration is distributed to the equity shareholders. When the liquidator is appointed, it will incur some liquidation expenses. There are some treatments for this liquidation expenses in the books of the selling company. If these liquidation expenses are met by the selling company itself, so we have to write the entry is realization account to cash account. But if the expenses are met by the purchasing company, nothing will be entered in the books of the selling company. Whatever the entry will be there, that will be entered in the books of the purchasing company, that we have already seen. That is, they will give entry as goodwill to cash account. But if the expenses are met by the selling company and the purchasing company has agreed with the selling company that they will reimburse the expenses whatever they are met by the selling company, the entry will be as like this. That is, first in the books of selling company it will record as purchase company account to cash account, because the cash is going out, that is why it is given credit, and the purchase company will reimburse this expenses. So, I have given it as a credit. Now, after reimbursement by the purchase company, the entry will be reversed, that is cash account debit to the purchasing company account credit. Now, let us see what are the disclosures to be made in the books of the purchasing company. In the first financial statements of the newly formed resultant company, these are the disclosures which has to be compulsory disclosed by the purchasing company. First, this we are compulsory disclosure. First, names and general nature of business of amalgamating companies and effective date of amalgamation, when this amalgamation has taken place, on which date, and the method of accounting used. We have already discussed that amalgamation is of two types. One is in the nature of purchase and another one is in the nature of merger. To accountify that amalgamation, there are also two methods for separate amalgamations. If the amalgamation is in the nature of purchase, we use the method to accountify in the books of both the companies is purchase method. If the amalgamation is accounted under purchase method, these are the some additional disclosures which are to be disclosed after disclosing the above 3 points. That is, the consideration paid by the purchasing company to the selling company is to be disclosed, and the description of consideration, that is in what form and what mode of payment is paid under the consideration. That is, if the purchasing company paid in the form of equity shares, that is in the form of preference shares or in the form of cash, that description is to be disclosed. And if there is any amount of difference between consideration and net assets acquired, that also be disclosed, and the treatment thereof is also be disclosed. If we get the difference goodwill, that amortization is also be disclosed additionally. If the amalgamation is accounted under pooling of interest method, these are the additional disclosures which has to be disclosed. First one is we have to give the description and regarding the shares and how many number of shares we are issuing to the owners of the selling company. And this additional point also the purchasing company has to be disclosed in its first financial statement. That is, if there is any amount of difference between share capital and assets acquired, that is to be disclosed, and how we are treating that difference also is to be disclosed additionally in the first financial statements of the purchasing company.